And welcome to ETF Edge, CNBC's newest show dedicated solely to the $3.5 trillion ETF market. I'm your host, Bob Pisani. Each week, we will break down the biggest trends and help you build the best portfolio in the world using ETFs. Today, we're joined by Dave Nautic. He's the managing director of ETF.com, and Doug Jonas. He's the head of exchange-traded products right here at the New York Stock Exchange. Let's get started today with the biggest mover, and that's biotech. Check out the IBB and the XBI Biotech ETFs, both of them up as deal talk in this space has been heating up today. These are the two largest biotech ETFs, but they are actually very different. Let's look under the hood at what's inside these ETFs. Now, the IBB is a weighted, market cap weighted ETF and includes names like Biogen, Gilead, Celgene, and Amgen, just to name a few. The top 10 holdings there make up more than 50% of that ETF. On the other side is the XBI, which is an equal-weighted ETF, all equal-weighted. It includes names like Celgene, AbbVie, and Incyte. The top 10 holdings, there are only 15% of that ETF. Doug, let me talk a little bit, Dave, let me talk a little bit with you about this. The important thing here is they're not the same. Market cap weighted and individually weighted or separately weighted is a completely different animal. Yeah. How do you choose between one versus the other?
Well, really, I think it's a question of whether you're looking for broad-based long-term exposure. If you're trying to catch sort of a particular earnings season, I think the equal-weighted strategy here, the XBI, the S&P, Spider S&P Biotech, gives you that broad exposure. It's actually a little bit cheaper, so you're kind of getting a double whammy here. Most of the time, these equal-weighted strategies tend to be more expensive. In this case, you're getting that equal weighting, that quarterly rebalancing, and you're getting it at a cheaper price.
I think the important thing, though, Doug, is there are certain limitations to the way these are constructed. It's just not market cap versus individually weighted. It's the way the index is constructed as well.
That's right. It's full investment construction that's different across products. So when we look at XBI, that's going to take in the entire marketplace of biotech and pharma, whereas when we look at the iShares products, the iShares ETF really limits it to just one exchange. So if it's only NASDAQ listed names, so you start to remove some of the largest pharma and biotech companies out there. Example would be Takeda. Takeda is listed here at the New York Stock Exchange. 30 billion in market cap wouldn't even be considered in the iShares ETF.
And yet, Dave, have a certain appeal. I see a certain appeal to equal weighted because it's essentially an investment strategy. We've talked about this many times. With an equal weight, after a certain period of time, say every quarter, you're essentially going to sell your winners and you're going to buy some of the losers. So you are essentially reweighting all of the time. Is there something to be said for that kind of strategy?
I think for long-term investors, the proof is in the pudding. Equal weighted strategies over full market cycles, up and down, tend to outperform precisely for what you're saying. They tend to reinvest in those value stocks that may be oversold at a point in time, and to sell some of those momentum stocks that maybe get a little pricey in an upswing.
So what should you do? If you're a long-term investor, Doug, do you choose one over the other? I have seen, in my 23 years covering the markets, I have seen big cap names that are in, for example, the market cap weighted index outperform dramatically, and smaller names fall by the wayside. And then we've seen some short periods where people try to buy the big cap of the smaller cap names. How do you decide what's the best investment strategy for you?
Yeah, I think Dave's point of full market cycles is really what it comes down to. Whenever you go away from a market cap weighting, you're effectively taking a bet. Yeah. You're making a factor bet, is what we would call it, and that factor takes, in many cases, a long period of time to expose itself. So investors, unfortunately, tend not to go through an entire market cycle, and then what we end up finding is when that factor is out of performance, they tend to sell. When it's in performance, they buy, and so what we've really seen is that market cap weighting in many cases, even though maybe you're overexposed to one name in your opinion, there is a reason that name is rising, and there's a reason the laggards are falling, and so effectively you're keeping in line with the overall marketplace.